Hi everyone, welcome to this new video about chapter 13, the cost of production. This is a book of Gregory Mankiw, Principles of Economics. I must apologize for my voice, but I really wanted to make this video today. So here we are going to start with the introduction part. Basically, what we really need to understand that we are going to be in the production side. So definitely we will need to use the base of the law of supply and its shape. What does it mean? Basically, the idea is like we are taking the condition that when a producer decides how much quantity is going to put in the market is going to depend positively of the price which is in the market, which is a positive condition. It means the higher price, the producer they have more incentives in order to put more in the market. It was the law of supply says, as we said before in previous chapters. The idea when we talk about the decision about the firms that they need to produce and sell the goods or services is what we call in economics industrial organization. Basically, this is the study how firms decision about prices and quantities depend on the market condition they face. So the idea here, we have a new perspective of economics because at this point it opens a new question about prices and efficiency in the market. So what about the prices higher in one market compare with the efficiency that we are going to face? So this is a new debate, a new dilemma that we are going to face with base with this information. So the first thing that we really need to take into consideration is the question, what are costs? So from one part we have this one. So we have the firms have costs of inputs. So if we think about cookies factory, they need ingredients. So for example, and as well they need devices as mixers, as oven, and then they need workers to operate them in order to like transfer or convert from inputs, make some added value, and as a result has an output. So the idea is like most of the firms run a business to make money. So then we can base our idea of study of firms as a goal. We can set the profit maximization of the firm. And we need to understand that as a common sense, the profit is divided in two parts. So you have something that you have as an income, which is the total revenue, and you need to outlay money, which is the total cost. And we can define the revenue of a company, of a firm, as the amount that a firm receives for the sale of outputs. On the other side, the thing that we need to subtract are the costs. And the costs, we can define them as the amount that the firm pays to buy, and here to buy, it means the you, buy inputs. So as for example, for sugar, workers, the salary, ovens, and so forth. So in this case, the money that you need to pay. Then when you make the subtraction, if it's positive, you have positive benefits. If it's zero, you have zero benefits. And when you have less than zero, you will face losses in the firm. So this is the first, the very beginning equation of each profit. It's equal to total revenue minus total cost. Then the idea is like each firm needs to make this profit, this equation, as large as they can. So this is the idea of each firm. So how we can define the total revenue? So it's immediate, that is just the quantity that is sold times its price. So for example, if you are running a business in your university, I don't know, in the United States, I've never studied there, but in Colombia particularly, you can sell stuff. So for example, in university you sell candies. Imagine that you sell during one day one candy by the time of $1. It means that 1 times 1 is going to be the total revenue for you this day. Then the total revenue is just price times quantity. Then, talking about costs, I must say that they are a little bit more subtle. Why? Because it depends on the point of view that you can interpret them and the way how you can plug into the equation. So first, this is the first part. What are costs? First, we can think about them as a cost, as opportunity cost. So remember, the first part, we're going to focus on this part. We can take our first video, which is 10 Principles of Economics, where we define the cost as opportunity cost. The cost of something is what you give up to get it, is what we call opportunity cost. My opportunity cost right now is make this video instead of watch Friends, which is my favorite series. But I know I'm doing this video, so for this reason, this is my opportunity cost according to me. And all those things that must be forgone to acquire them, all things that you cannot take at the same time due to you are paying for that. That's the other point of view of the opportunity cost. So, for example, even paying $1,000 for an input cost, even you can consider it as opportunity cost. Why? Because, for example, instead of paying that money, you can use that money in order to buy another stuff. So this is your opportunity cost, even for capital, even for money. Then, when you need to outlay money, are explicit cost. But we are still talking about opportunity cost. Then we have one which is implicit, and the other one is explicit cost. So in this case, as I said before, other activity that must be forgone to run the business is included in implicit cost. At the end, we can summarize that total cost is the sum of implicit and explicit costs. Then this is a real important thing that we really need to take into consideration between contents and economics, because here we can see a really important fact where these two areas they are different, because accountant they will not take into account the implicit cost. However, economists they take into account this, because it makes part of your decision. When something is really cost to you as an opportunity cost, even if you don't outlay any money, this is going to be taken in consideration. Okay? Then what are costs still? So now we're going to talk about the cost of capital as an opportunity cost. So as a cost of capital, we can think of capital as the money necessary that you need to pay in order to run your business. So then imagine the scenario that you have $300,000, and then you face a dilemma. This dilemma is between buying a factory or simply keeping this money in a bank. So this is an opportunity cost. For one side, from one side, when you put this money in your firm, then you will receive ahead some return on your investment. On the other side, when you put that money in a bank, you will receive an interest rate. Then you can see here how this could be an opportunity cost. And definitely it's just going to be taken into consideration in economics area, nor not in the accountants field. Then now imagine a little bit different this example. Imagine that you borrow part of this money. So let's say that you borrow $200,000 and you have in your bank account you have the other part. Then at this time you need to pay an interest rate for this money that you borrow. So when you borrow this money and automatically you need to outlay the interest rate of this loan, at this time the contents part is going to be taken into account. So you see the difference in both we consider as economists. In the other part, accountants, they just only take care when is the second position. Then what are again we're going to talk about economic profit versus accounting profit. We already talked about the cost. Remember, economists they take into account, or we take into account just both. We take into account both, and accountants they take into account just explicit. So for this part, we can have this graph, which is basically a different point of view how uh, accountant and economist has a different view of profits. Then the first one, an economist, we have again the same revenue for both. Both have explicit cost, okay? And here is the difference. The economic profit for economists is smaller than the accounting profit. Why? Because an economist take into account the implicit cost, but accountant they don't. So this is basically the idea. So at the end, the total opportunity cost we consider this one, and the total cost for accountant is this one. So that's basically the difference. So then an economic profit motivates the firm to supply goods and services because even if you don't take into account as a content this money, definitely it will make part of your decision of running a business. Then the idea is like a firm making positive economic profit will stay in business. Otherwise, depending on the situation, it can disappear or go out of the market. Then the idea is we need to examine the profits in order to verify if the firm will stay or not. Then we will talk now about the production and cost. How is the relation between them? What are the main definitions that we really need to really be confident with this definition in order to build um, a knowledge in economics? Then, first, when a firm incurs in cost when they buy inputs to produce goods and services. Okay, and then actually during this chapter, we take a cookies factory, which is called Caroline's. And then the idea is like we have two main assumptions of this firm. The first is that the size of the factory is fixed. What does it mean? Basically, it means that you have a shop where you have inside the cook, the kitchen, where you can prepare these cookies. Then you cannot change this kitchen from one day to another, let's say overnight. It takes time. So for this reason, we assume that the size of the factory is fixed. This is really important assumption. What we are trying to say here is that we are talking about short run, because maybe in 1 year or 2 year horizon you can make the changes in order to have a factory or a kitchen higher. So this is important. So the size of the factory is fixed. It means that we are talking about short run. Then we automatically think about the labor, the workers. they they can be moved. So then the quantity of production can be modified by changing the number of workers. If I hire one additional worker, the production is not going to stay the same, and I can contract them or hire them as much as I want. There is no restriction as the restriction of the kitchen, which is kind of real. You can understand and you can think about this one as really common assumptions. Then, as I said before, we're talking about short run at this time. Then we are going to talk now about the production function. Remember what is a function. Remember from maths. Okay, next time I'm going to put videos about mathematics for economics. At this time, the function, what it is. Basically, it is a relationship between one, you have as an input one thing, and you receive only one result, only one outcome. So from one x point, you will just have one and only one point in the y-axis. This is a function. Otherwise, it could be maybe a relation. So as a circle, for example, you have maybe some x-axis that you have 2 points in the range. So y-axis is the range and x-axis is the domain. So in this case, we have something like here. We have inputs, so flour, the sugar, the mixer, workers, and you have an output. At this time, we're going just to focus on workers, on labor. So how you move, you hire your workers, and you have different results. That's the idea what we're going to work in. Then, this is the relationship between quantity of inputs used to make a good and the quantity of output of that good. So workers and cookies. That's the idea where we are going to take into account. So here we have a part of the table which is shown in this chapter. Basically here we have the number of workers from 0 to 6, and naturally they produce something. So if you hire 0 workers, naturally the quantity of cookies produced per hour is going to be 0. Okay? If you contract no one, you won't have any cookie. That's okay. Then at the time that we start to hire people, we just to start to produce something. So if we have one worker, this guy is going to produce 50 cookies per hour. When I have two, these two together they produce 90. And so on and so forth, and this was 6 workers, they produce 155. Then we can graph this table, so we can represent this in a table. Remember to label the axis in order to understand what we are talking about. So the first axis, as I said, this one is going to be our input. Our input is going to be considered the number of workers hired. So here we have from 1 to 6. So 0 they produce 0, 1 they produce 50, 5 they produce 150, and 6 they produce 155. So this one is what we call the production function. So this is the relation between the labor that you hire and the result as outcome measured this time as cookies per hour. So this is basically the production function. Then here we start to introduce new important concepts in economics. So the first part that we are going to introduce here is the marginal product. What's that? Basically, is the measure of how much increase our output when we use one additional worker. So this is the relation between them. So then automatically we can notice the diminishing marginal product. So what does it mean? So if we consider this one is the table that we represented before, and we add the marginal product of labor, it means the next. The marginal product uh, the marginal product of the first worker is going to be 50, because when we increase in 1 from 0 to 1, the quantity is going to be changed in 50, okay, from 0 to 50. Then when I hire the second worker, at this time we have the first 90 minus 50 is going to be 40. Okay, this is going to be the marginal product of the second worker. And the sixth one, when I hire this next guy, our production is going just to increase from 150 to 155, which is a marginal product of labor 5. We put here between the rows because it means change for each labor, for each worker. Okay, so that's the idea. And now why we can notice that the diminishing marginal product? Basically because, as you notice here, is going to be less, less each time. So why does it happen? Basically it happens because imagine that you have the same quantity of mixers, the same quantity of the same, let's say, size of your kitchen, but you have more and more and more workers. Then actually at one point they're going to be one against another one, so it's not going to be, they're not going to be kind of free in the kitchen. They're going to push other one. Maybe they're going to be like really non-comfortable working. So for this reason, we say that this is a diminishing marginal product. It's logical because you have the same capital, but you just move the labor, and they are not going to be as efficient as the previous one. And here we have the quantity of, again, what we had before, and we are going to now take into account the cost curve. So here we have the next. So this part we already analyzed before, right? Now this we have three new columns. The first column is the cost of factory. This one is what we call fixed cost. What does it mean? Basically, it means the cost that you need to pay regardless the quantity that you produce. So as you verify here, it doesn't matter the number of workers, it doesn't matter your production, you need to pay every single time $30. So it could be, for example, rent. It doesn't matter, they don't care if you're producing one cookie or 1,000 cookies, you need to pay that. Then we have here the variable cost. The variable cost in this imaginary example is about the cost of workers. So if in this time you imagine that each salary per hour is going to be $10. So the first worker is going to be 10, the second worker is going to be 2 times 10, so on and so forth until this one. 0 is going to be the first one because you are not hiring anyone. Then your total cost of input, so it's going to be the cost, fixed cost plus the variable cost, is going to be this one. As you notice, level here, which is increasing. Then we have here the graph. Remember, label all both. So we have here total cost measured in dollars, and here we have the quantity of output. Where what we notice here is that this increases, and actually it gets steeper when the quantity of output increases. Now we need to analyze this one from the relationship between the production function and to the total cost curve. So here we continue with the relationship between the production function and the total cost curve. So here the idea. So the idea is, as you notice, these two, they have a relationship because as you notice this one, it gets uh, kind of flatter, this one, and is what we call the marginal product, which is basically the slope of this production function. So for this reason, we have this one is going to be, the increase is going to be lower. So for this reason, it's getting flat or flatter. Here, in the other side, we have the total curve, which is getting steeper. So at the time that we increase the production here, the quantity produced, the total cost increase higher. So you see here like the marginal cost start to increase, right? Here is the area. So we have this the opposite. Then the cost gets steeper and the total production gets flatter. And this one with the diminishing marginal product. Then here we analyze the cost fixed and the variable cost. So the fixed cost, as we said before, they don't vary with the quantity produced, which is the rent. The other part, the variable cost, they vary with the quantity produced, so as coffee, beans, milk, sugar, and paper cups in the case of our example of cookies factory. So here we have another example of another, this one, I'm sorry, this is not more the cookies because we're talking the coffee beans, so we're talking about a coffee shop. So here we have the output, so we have no more cookies per hour, but now we have the cups of coffee per hour from 0 to 10. Here we have total cost, which is, remember, it is the sum of fixed cost plus variable cost. So here we have fixed cost is going to be $3, so it means immediately that it doesn't matter how much it doesn't matter how much, how many this time, how many cups of coffee you produce, it's going to be the same, $3. And the variable cost, they depend on production, and they naturally is going to increase as the production increases as well. So here we have the total cost curve as is practically or almost the same as before, which is positive, and it gets cheaper when the production gets higher. Then we're going now to analyze the cost, the average cost or average total cost and marginal cost. So here the average cost comes from answering one question. So if, for example, we have a question, how much does it cost to make a typical cup of coffee? So what is the average cost of producing a cup of coffee? And then we have another question, which is the marginal cost, which comes from answering how much does it cost to increase production of coffee by 1 cup. So the idea is like, if I produce one, what is the cost of this new unit? So it's what we talked before in the 10 principles of economics, that economists think in marginal terms. Then we can define them, we can convert them in order to start to put a little bit equations here. So the average total cost is going to be the total cost divided by the quantity produced. This is the cost average of each single output. Then in abbreviation we have ATC is equal TC over Q. So this is our first, actually second equation, because the first one was profit equal revenue minus cost. Then we now here have the marginal cost. I completely understand that this is not immediate, but you can grasp the idea. So the idea is the marginal cost is how much is going to be the cost of this additional unit produced. So we have here in the numerator, we have the change in total cost. So what is the change? For example, if we are talking about the marginal cost of the second unit, so we're going to be the subtraction between the total cost with the second unit minus the total cost of the first unit. And on the denominator, we have the change of quantities produced. So in this time, actually, because we are talking about marginal terms, usually we have over 1. Okay, because it's going to be 2 minus 1, 3 minus 2, 4 minus 3, so on and so forth. So in abbreviation, we have MC, which stands for marginal cost. We have in the numerator delta. This triangle is what we call in the Greek alphabet delta, which represents change. Every time we find this delta in our text, they will represent likely change. So change in total cost over the change on quantities. Then we can automatically from here we can we can split that in two parts. Remember that the total cost is divided by fixed cost plus variable cost. So if we have the average total cost, naturally we will have the average fixed cost. So we have the numerator the fixed cost and denominator quantity. We have FC equal FC over Q. Then analogously, we have here the average variable cost. Variable cost over quantity was what we call here a VC equal VC as a variable cost over quantity. Then the average cost says the cost of typical unit. It doesn't say anything about changing of production, but the marginal cost says the increase of total cost when you produce one additional unit. Then here we have the complete table of this new company that they produce or they offer cups of coffee. So here, so as I said before, here in this table we have the complete information. So let's understand every single item here. The first one we already understood. It is about the output, which is measured with cups of coffee per hours. Then the total cost, which is the sum of fixed cost plus variable cost. Okay, and then we start this new one. This first one is going to be the average fixed cost. Here, because you have zero produced, and when you divide the total cost, which is going to be $3 over zero, is going to be indeterminate. It doesn't, you cannot find a number that you multiply by zero and you will find 3. Then this one we have nothing because it's over zero. Then this one is going to be 3. Why? It's going to be 3 divided, and this time I'm sorry, here we have the average fixed cost, which is going to be this one. 3 over 1, 3 over 2, it's going to be this one, 3 over 3, so on and so forth. As you visualize here, it's every time is a decreasing curve. Logical, because you have the same value, which is a constant, divided by a higher number of productions. So it's going to be a decreasing curve. This one, the average fixed cost. Then the average variable cost is going to be this one divided by the quantity. So 0.30 divided 1 is going to be the same. Let's take this one. 4.80 is going to be 6, and 12 over 10 is going to be 1.2. So here, what's the idea? If you notice, here we have it increases all the time, right? It increases all the time. But for actually by this example, because it's not going to be every every time the same. So this one, the average fixed cost is going to be every time the same. This one, no. It's going to be maybe different. Okay, here the average total cost here it's going to be kind of a constant. I mean, the idea what I say constant is because it's going to be the same U shape every time. Why? Here we have 330, it decreases here and then it increases. You notice here, so for this reason it's a U shape. It has a decreasing part and then it has an increasing part. Then the marginal cost. So remember, marginal cost is the change in the cost over the change in quantities. Every time the change in quantity is going to be 1, so the denominator is going to be 1. Here is going to be the cost, total cost, have a look here, 330 minus 3 is going to be 0.3. 0.3 here. The other one we have, for example, here 7.80 over 6.50 is going to be this one 1.30, and we put rows again because it represents change. So for this reason you put between the rows. Here, as you notice, is every time increasing. Okay, so notice here that in the minimum of the average total cost is going to be exactly the same as the marginal cost. It's the only part when it's going to be exactly the same. Why? This is not by chance. Actually, we will find out why this happened. So here, when we represent the previous table in a graph, we have, as we said before, first lies the ATC, average total cost. So the average total cost, it has an U shape. As I said before, it's going to be U shape. So first it decreases and then it increases. Okay? Then the marginal cost every time it increases. Okay? Then the average fixed cost is always decreasing, as I said before, because you pay 3, and it doesn't matter how many quantities you produce, every time you need to pay 3. So average fixed cost is going to be decreasing. Okay? And then the average variable cost is increasing all the time. As I said before, it is not always the same. So what curves are always the same? This one, average total cost and average fixed cost. This is going to be every time the same. The other ones, marginal cost and average variable cost, they will change a little bit. It depends on the situation. So actually we're going to explain ahead which is the difference when we have a marginal cost and average variable cost when they behave differently. Here again we have the graph. So what is the idea of marginal cost? Remember that this slope represents the diminishing marginal product. So what does it mean? The production function, when you determine the slope of this one, which basically represents the change when you increase in one unit your worker. This time, this is the marginal product. And in the other side, the slope, so it means the cost that you produce one additional unit, it is basically related with the marginal product as well. So this is a relation between the production and the cost as we saw before. Then when they produce a small quantity of coffee, he has few workers, so there is a lot of equipment that is not used. Then the marginal cost is small. And then once you have much more workers, the cost of hiring a new one is going to be much higher. And this is directly related with the diminishing marginal product, because this additional worker is not going to produce as well as the previous one. So this is the relation between them. Here, the ATC. There is something, as I pointed before, about this $1.30. Why? This is going to be exactly the same. So we are talking about this point exactly, 1.3, which is going to be between 5 and 6. So why is so important here? Why they are? It is the meaning. It's the same. As you notice, before this point, it was decreasing. After this point, the ATC it increases. And why does it happen? Basically, imagine one situation. Your GPA, yeah, you have your grade point average. I don't know, in the United States, in Colombia is 5. I would say 10, just for saying something, I guess. Going to be 10. So they imagine that's going to be 10, your maximum point. And until now, you have 8 over 10. This is going to be your grade GPA. Then imagine that your next exam is going to be 9. So you will have 9 over 10 because you saw my video, so you have a better grade. So if your next exam is going to be 9, okay, which what we call or which we compare with marginal cost, then your GPA, which is going to be your ATC, okay, your average total cost, will increase. So here's the case. When the marginal cost or your next exam is going to be higher than the average will increase. Okay? When we have the opposite, it means that your result is lower than 8 because you didn't see my videos. Then at this time, the ATC is going to decrease. Marginal cost is lower than the ATC, so for this reason, ATC is going to be decreasing. And imagine that it's going to be 8, so it means that at this time the marginal cost is exactly the same to the GPA. And actually in economics is what we call efficiency scale. Why? Because at this point you are producing for each unit, the typical unit is going to be the lowest possible. The lowest possible production. So the idea is that you will face at the minimum average total cost possible per unit. Then we have another, as I said before, another type of curve that maybe can represent our cost of a firm. This one, what is the difference? ATC is exactly the same. Just notice here, it's going to be U-shape. The AFC, the average fixed cost, is going to be exactly the same. It will be decreasing all the time. Here is the change. The marginal cost here is not just increasing, but has one part decrease. And actually, the average variable cost is going to be decreasing at some point and then start to increase. So, what is the idea? The idea whether the function production does not face immediately diminishing marginal product. The previous part, it was the case when the function production it faces immediately diminishing product marginal product. It means that one worker additional it produces immediately less than the previous one. Here is not the case. At first, you have increasing marginal product. It means you have just one worker, but when you add the second worker, for example, the first worker produces 10 cookies. The second worker, as a whole, they produce 30 cookies. So it means that it's going to be the first one, which was 10 marginal product, and because the other one was 30, it's going to be 20 marginal product. Is what we call increasing marginal product. And what could be the case? It could be the case that maybe the first workers, these first 3-4 workers, the 3-4 workers that make these 4 new production, 4 units of production, they can divide the work and they can be more efficient. So this could be the case why these curves are modeled or a shape like this. margin cost this one at the average cost as well. But the important part that it doesn't change at all is that the marginal cost could in the minimum part to the AVC as well to the AVC. And AVC plus AFC, you will notice it's going to be this one. Yeah, because if you sum, for example, this one plus this one, you're going to be this one. Okay, so that's the idea. When the units increases, these two is going to be automatically almost the same. Okay, despite the differences they have in common, the most important properties. First, the marginal cost eventually rises with the quantity of output. So maybe it decreases the first one because of the division of the work, but then it increases. Second, second condition. So here, with the second condition is that the average total cost curve is U-shaped. As I said before, this one is U-shaped. And the last one, the marginal cost curve crosses the average total cost curve at the minimum of the average total cost. So this one, marginal cost crosses the minimum and the minimum. Okay, then we're going to talk now how is the relationship between short and long run. So the idea is like in the short run, as we said before, the firms they cannot change the size of the factory. You cannot overnight build, construct a new factory for producing more or make lower to produce less. So for this reason, we keep this fact a constant. Then in the long run all the costs are variable, so that means you cannot overnight change your your this case you have for example your factory, but in the long run you can do it. Then for this reason we have here we are talking about the short run. So here we have a firm that produces water. They produce cars per day. Okay, this is the quantity, and here we have the average total cost. So imagine three firms. So we have three different firms. We have one firm which has a small factory, so it's going to be this one. So they reach the minimum when they produce this quantity, right? We have another company which is going to be the medium size, where they produce this quantity and actually they reach the value of 1000. But when they need to produce 1200 cars, the cost will increase to 12,000. So here, this is the second plan. And the last one is going to be this one, which a huge factory because they reach the last, yeah, so the lowest value of the average total cost of this part. So here we have three different factories. The point here, what I want to show to you is that this one you cannot change. This is the curve that you decide. This one is what you decide. This one is what you decide. You cannot move between them. The difference is in the long run, because in the long run you can decide if you can use the first, second, or the third factory. Then when you take all these curves, you take the minimums of this one, you have what we call the average total cost in the long run. So this is more flexible because you can choose this one or this one. You have different levels of production where the average total cost it doesn't change too much as the production. Then it depends. It's important. We have always this question. So when is the long run? It's going to be 1 month, 1 year, 2 years, 10 years. The idea it depends on each field. If we are talking about the cars industry, when it takes more time to create a new factory, or you talk about a coffee shop where you just need to buy a new device, I mean a new oven, a new a new mixer or something like that, they could be that a case going to be lower the horizon or to be in the long run. So here, now we're going to talk about what we call economies, and these economies of scale. So here, in the long run, the average cost downwards slope, it is economies of scale. So here is what we have this one. Okay, so we have here small quantities. The economies of producing more is going to decrease. So it's basically more of the time because of specialization. Then when we have the long run average total cost is upward slope, it means these economies of scale because you produce more and the average total cost increases. And this one is what we call again. Sorry, here is a misunderstand. The idea is like here is what we call the, because it's really hard to manage this idea, this because it is more people, so you cannot keep the average total cost as low as before. And this one, during this part what is constant, this is constant returns scale. It means that it doesn't matter if you produce from this point to this point, but you're going to still produce at the same average total cost. Here actually you remain $10,000 compared with 12,000, which was in the previous situation in the short run. Okay, so as a conclusion, we already established the basis of cost, what we're talking economics, and here we have summarized all the concepts that we already saw about explicit cost, implicit, fixed, variable, total, average, fixed, average, variable, average, total, and marginal cost. We have here the definition, and here the mathematical description. Next, again, I apologize for my voice, but anyway, I really want to make this video today, and I hope it's worth. Any doubt, any suggestion, please write in the comments, and I will really appreciate to have a lot of them there in order to understand what's going on with that. If you understand, if you follow the explanation, and that's it. See you please the next video and have a great day. Bye bye.